Good morning, everybody. I'm John Kaiser. The topic is the gold rally. Is it a flash in the pan or the beginning of a major repricing in gold? And that's a very important question because the junior resource sector is in very poor shape and really needs a sustained gold rally to keep it from just fading away. So I've been telling my subscribers that stop looking at the recent past, look into the deeper past. If you look at this 50, 60-year history of gold, you can see that period in the 70s where when it was delinked from the US dollar, it had that huge rally, went from $35 to $8.50 and basically stabilized at $400. That period had inflation, but what it also had was a great degree of uncertainty about what America's ongoing role on the global stage was going to be. They had their asses handed to them in Vietnam. OPEC beat them up. Iran took the embassy hostage. They couldn't get their planes to come in and rescue them because they got sand in the gears. And the Soviet Union made this foolish decision to invade Afghanistan, sort of signaling, okay, we're going to win this Cold War and expand the Soviet Empire. And that, when gold settled back after Volcker killed the inflation bubble, we had a 20-plus year bear market in gold. The Americans ended up winning the Cold War. Then we had the dot-com revolution come along. But then in 2002, 2003, the China supercycle came along. The United States did overreach in Iraq, decided that they needed to enforce their presence in the area, which ironically was a strategic error because they did not understand that shale oil fracking was going to eliminate America's dependency on oil. And then came the financial crisis, and in the aftermath we saw gold rally all the way to 1950 or so, couldn't break that $2,000 mark. And ironically, the gold bugs, with their enthusiasm for austerity and taking control of the House in 2010 and doing this debt ceiling extortion, they basically ushered in a period of austerity where the only real stimulus was monetary policy, having the interest rates really low and printing up money. And the argument was, oh yes, this is all going to cause fiat currency debasement and hyperinflation. And we ended up with a 8-year bear market for the resource juniors, for the metals, for gold also. But in 2016, the surprise election of Donald Trump has created a new period of uncertainty. So I'm suggesting that rather than look at the recent tea leaves, look way back into the 70s, because we are in a period of flux where nobody really knows what directions this world is going to take. There are all kinds of nasty trends out there that could destabilize status quo assumption. And the Make America Great Again strategy of America First and Only, this is changing the way everything has been thought about since the end of the World War II. Most people are looking at the period of, when gold rallied to 1950, and they're frightened. They say, gold's going to do the same thing. It'll challenge 2000, and it's going to then fade back again. And we don't want to get sucked in again like we did before. I'm going to make the case that, no, this is different. You got to go back many decades. Gold's going to blow through 2,000 over the next 18 months and challenge 3,000, and then create a new base between 2,000 and 3,000. That'll be a real price gain, and that'll be as important as gold stabilizing at $400 in 1980. This is just a quick picture of how terrible the situation is for the juniors. About just under 1,200 of the TSX Venture listings are still in the resource sector, but less than half of them have more than $200,000 in the treasury. In a sense, it makes life easier for people like myself because I don't have to screen as many companies to focus in on those that deserve deeper analysis. But the sector is dying. Unless this bear market turns around, you know, as I remarked last year, these types of conferences are going to be like typewriter conferences by people who don't understand that the word processor and PCs is now the new way stuff gets written. That has to change. And I think the gold price rally, a sustained rally, is critical to saving the sector and bringing back lost audiences. So this just gives you a picture of traded value. The blue is resource listings on the venture, and the green are non-resource listing. And the red and the yellow lines represent the relative percentage of total traded value. And you can see they were sort of roughly in line during that last bull cycle we had in 2010 to 2011. But then it came apart in a big way, and non-resource stocks have dominated the venture. They tend to be more of a winner-take-all type of psychology, like cannabis. Like each cannabis company can end up inheriting the entire universe, so you can have each one priced as if it's going to be the winner, and the total value of them all far exceeds the ultimate value of the market. But what I want to point your attention to is this here. This is now changing. So you can see the percentage. It's back to 50% for the resource juniors, and that's all in the last 3 months, and it's tracking the price of gold. But the traded value is still relatively small, and that reflects the reluctance of the audience to take this seriously. So this is probably one of the best times ever to be paying attention to the resource juniors. And this gives you more granularity, and what I want to point out here is the cannabis cycle, the bubble, has been really harmful. It allows momentum trading. You don't need to think about what the story is, like what is the geology, how big's the deposit going to be, all these complicated things. It's simple. You just trade the momentum. Except now that it's legal, it's starting to fizz. The cannabis bubble is over, at least for the Canadian companies. Now, this chart I always show because I really want to emphasize that the move to $400 in 1980, that was a 400% real price gain from what the assumptions had been at the start of the 70s. That made a lot of high-hanging gold fruit very low-hanging gold fruit. And the 3 billion ounces that existed then was expanded to 6 billion ounces by the mining industry during that period. But that blue line is the important one. If you use the CPI and inflation adjust to the present, that $400 gold is $12.51, which is why even though gold's been bouncing around that level and is sort of 5 times higher than where it was at the bottom in 2001, it hasn't really made any difference because it's just an inflation adjustment. So even that rally that we had in that period 2009 to 2010, that was simply an inflation catch-up rally. So what we're looking for now is a real price gain into the $2,000, $3,000 range. And all the gold that exists right now is still only $9 trillion of a drop in the bucket in all the world's asset classes. So to consider that it could double, it's not that big of a stretch. Now, the big story is China versus America, and I've been using this graphic for a long time. You can see the relative convergence of America as the dominant economy, getting ever closer with the trajectories that we have by 2030. They should be even. Trump has sounded the alarm, and rightfully so, because China, all hopes we had of them becoming more like a Western country, those are over. They've slid back into an authoritarian, totalitarian system where they have hyper-surveillance of everything, they suppress everything, and really that's not what we want the future to be guided by. So the trade war that he's initiated, it's legitimate. The problem is it's being done in a way that China has no way to negotiate a change. This is a winner-take-all battle that has been set up, and Trump is destabilizing this idea of globalized trade to more, every country for itself, have everything inside its own country as the sort of basis for the economy. And this is now what's causing all the turmoil out there. And the American consumer has yet to feel the impact of the tariffs that are being introduced. That will start to become apparent next year. And next year is a very important election year. So this is the graphic that has everybody mesmerized. The green line is the difference between the 3-month and the 10-year yield on Treasury bills. And every time you see it dip below 0, that has always coincided with a recession. And so all the hand-wringing now is, okay, we have an inverted yield curve, and it is below 0, and does this mean that a recession is imminent? But it's not so obvious that we will get a recession. The trade war, with all its impact on manufacturing and disrupting supply chains and all that, manufacturing is only 12% of the US economy. It will take a lot to actually cause a recession in the United States based on a slowdown in manufacturing. The United States is a service-based economy. And that also means it does depend on the rest of the world, and this strategy of trying to make everything come back to America, it is a foolish strategy, and all the mainstream economists and even within the Republican Party, they're all telling Trump, you can't do this. Allow these globalized supply chains to exist. And in fact, nobody's moving manufacturing back to America. There's just so much uncertainty. What they are doing is moving manufacturing out of China. Problem with that is most of it is in Southeast Asia, and one of China's ambitions is to expand its footprint in that area. So just escaping the China trap, that's just a temporary solution. So this has everybody thinking the Dow, all the general equity markets are due for a major correction. And last year we saw, you see that little dangler there? It looked like everything was going to fall apart, and yet it didn't. But there's a really big problem with the valuations in the equity markets, which is that they are already pricing pretty good assumptions about the future. So a big problem is what is the return going to be for these levels in things muddling along in the way they are? There's no evidence yet of a recession in the United States. Consumer sentiment is still reasonably strong. We're not going to, there isn't any reason for it to, go significantly higher or go significantly lower, though there is, because the way markets work, there is a potential for a significant correction, and that's going to be the basis for why everything's going to be really good for gold, because Trump has tied his approval rating to how the market's doing. If the market does a pullback and they've chopped the interest rates next to 0, there's nothing that monetary stimulus can do really to make anything better. And this is a problem in Europe too also. So I'm saying the black swan nobody's really paying attention to is the dependency on this advertising, social media model where the privacy of everybody has been harvested and used. Originally, it was just used to serve up ads to the millennials, and they didn't really care about that. But Netflix just released The Great Hack, a movie that's an hour longer than it needs to do. But what it does is it explains how Cambridge Analytica was able to harvest data starting with a couple 100,000 Facebook users and then reaching into all their friends, eventually pulling 87 million names with 5,000 data points associated with each name, and then profile everybody in terms of their personalities, their vulnerabilities, their likes and dislikes. But then the next important thing is they used big data analysis to figure out where in America there were subtle tipping points where a simple nudge could actually change who won the state. And they figured this out and then targeted those vulnerable individuals with advertising that wasn't there to sell them some product, but to manipulate the way they think about it. And so the Trump election wasn't really achieved by the Russians meddling. It was actually achieved by Americans, Bob Mercer and his daughter with Steve Bannon bankrolling this very sophisticated belief manipulation system. And we are now in a war. Now it's not just this Republican group doing it. Now it's everybody doing it. And people are starting to understand that my data, I don't care if you use it to sell me stuff, but if you're using it to manipulate me, I don't want that. I want to think about stuff on my own. I want to have a choice, not have the illusion of choice. So I believe there's a backlash coming, and we could see the Googles, the Facebooks suffer severe market corrections. And that could be what makes the equity markets go down in a big way. And that also will disrupt the employment situation because so many people have jobs in this area. So watch for that black swan. So right now, I don't know to what degree you see it in Canada, but in the United States, there is an atmosphere of real turmoil about what's all going on. The showdown between China and America, I think it's going to lead to a fragmentation of the global economy into a smaller trading units. This fascination with authoritarianism, that's in particular in the Trump camp, that's really disturbing, and it's being pushed all over the world as the democracy is dead, smart dictators running everything, that's the way things should be. And there's also this backlash against stuff that used to energize gold bugs, which is libertarianism and their winner-take-all attitude. The base has not really benefited from globalized free trade. I mean, the elites have emerged as the winners, and they're now not American, they're international entities. When Trump says you need to move back to America, why? We have some stuff in America, but we're not truly American companies. Now, the reason I see a reluctance of investors to move into the resource juniors based on this pretty significant move in the price of gold is because intuitively they know that a thumbs up for gold is a thumbs down for Trump. And the gold bugs are almost universally in favor of Trump. So they're conflicted right now. They don't really want to embrace gold because that is to give a thumbs down to Trump. And I look at this and say, well, what about the other half of America, the so-called liberal half? They've always shunned gold because it's this thing that the right-wingers are all into. But now we have a situation where everything's going into flux. And the traditional gold bugs are a little leery of gold. So gold is available for an entire new audience to embrace it as a hedge because there's no guarantee that Trump will get kicked out in 2020. He could be here for another 4 years. So I suspect that when you look at people like Sam Zell and Ray Dalio, these people are already signaling that gold is the place to be. So there's three things that sort of drive the enthusiasm for gold. One is the old story of fiat currency debasement and hyperinflation, blah, blah, blah. That can happen. We see it in places like Zimbabwe. But that's not useful to the resource juniors at all because the costs of producing something go right up along with it. So a higher gold price because of this is meaningless. It doesn't help us. The whole narrative of the past couple decades has been nonsensical as far as the resource sector is concerned. Prosperity is a much more important driver, and that big move during the first decade of this century, that was because the global GDP doubled in that period, and gold is a natural place for wealth to park part of itself into. So when you have a growing wealth of the world, the gold price naturally goes up. But uncertainty, that's the other one, and that's the one that relates back to the 70s. Uncertainty now is the big driver. So the US dollar, people, currency decline and all that, what's the US dollar supposed to go down against? There is no alternative right now, but the whole world is frustrated by its dependency on the US dollar as the single reserve currency, and they are unhappy that the United States is abusing its role to bully everybody into like following whatever random sanctions they unilaterally declare, like the situation with Iran and its nuclear policy. Don't expect the US dollar to go down in a big way. It may retreat. In fact, Trump wants the US dollar to go down because right now China is exploiting the strength of the US dollar to offset some of the hurt that it's suffering from the tariffs. So the tariffs haven't had quite the impact hoped for because the US dollar has been so strong, and China has started to allow its RMB to slide, not necessarily as a key strategy, but because it is coming under economic stress. So this chart here, this was what really agitated all the gold bugs in the past decade. It's the rising American debt. But they don't seem to care so much anymore because now their man is in charge and he's cranking it higher than ever, and it's now $1 trillion deficit, and there's no reason to expect it to go down. So this, as a driver of enthusiasm for gold, it's not going away. The Republicans are completely behind expanding the total debt. And if the Democrats do get in, well, you think they're going to reverse that? Maybe if something miraculous like a dot-com revolution happens that enabled Clinton to actually get the budget balanced, but I don't think that's in the cards. So that's going to be a continuing issue. And here is how you look at the uncertainty and prosperity thing. And the chart on your left, it's basically the value of the gold stock divided by the value of the global GDP. And you can see that it had a low of just under 4% around 2000, 2001, and a high of 25% during that 70s run-up when there was extreme uncertainty about what role the United States was going to play going forward. And if you convert that back and use those percentages, the chart on the right says that the equivalent for that 27% in 1980 when gold hit $850, today is $3,500. So if the world goes into a state of anxiety, as it did in the 70s about America losing it, having it go to $3,500 in real price terms, and then settling back into sort of the $2,000 to $3,000 range, that's not unprecedented. The math says it's happened before, and it can happen again. So I have just a few minutes left here. Silver is going to track gold, but even better, it will temporarily outpace it because unlike gold, where all those 6 billion ounces are technically for sale, most of the above-ground silver stock is fabricated into something, so there is a relatively small float. And there is an audience which views silver with almost a religious cult-type following, and they have this belief that somehow the gold-silver ratio should be a lot lower than it actually is. There's no logical reason for that, but they have just done that sort of, made that connection. So you could see the float of gold get mopped up by speculators buying silver, which could get silver into that $20 to $30 range, which will be very good for those companies with a key silver component. Now, I think that Trump will have to keep the one promise he has ignored. If we get that market pullback and we get all that turmoil that I'm expecting we will see by early next year, by actually going on an infrastructure renewal spending binge. With interest rates really low, why not issue more debt to truly make America great again by repairing its decaying infrastructure? And Germany has the same problem. They have this black zero policy they created in 2009, which requires balanced budgets, but its infrastructure is not so spiffy as it used to be. And their economy, which is export dependent, looks like it actually is sliding into a recession. So you get countries like Germany and the United States finally start spending money on infrastructure. Well, that's good for gold because we know the total debt will keep rising and rising. But it's also good for all the other metals, because that means there'll be raw materials required to do this. Giving that big tax break, it just went around in a circle. They used it to buy back their shares and pay out dividends. They didn't really make the investment. And what Trump needs to get businesses to really invest in America is to create a true sense that the country isn't living in an end times psychology where everything is hopeless and getting worse, but is actually going to get better. So the chaos created by this trade war, I think, will unleash massive infrastructure spending all over the world, and that's going to help pull our juniors out of this mess we're in. And the one metal that should benefit the most from this is zinc, because warehouse stocks are really low and yet the price is weak. China's ability to expand production is limited after taking over in the last 30 years, and they have an environmental emissions problem. They're trying to keep their emerging middle class under control, but people don't like pollution. So that is the one sensitive spot that the Communist Party in Beijing has. They can't just crush the environment and everybody downstream the way they have to be. So zinc would benefit if this infrastructure renewal thing becomes reality. But the way the market's pricing it, it's saying there's actually a global recession coming and demand is going to go down. Zinc is primarily linked to the macro economy. And the uranium, I don't think uranium's ever going to come back. Kazakhstan has a lock-on supply. They're not really going to reduce it. But uranium's problem is that the shale oil fracking industry, which has created self-sufficiency for the United States and made America not care so much about the Middle East anymore, to the point where if all hell breaks loose with Iran and Saudi Arabia and that, big deal. We have plenty of oil coming from our shale fracking. But more importantly, we have natural gas, which is really cheap now, and it is displacing coal, it is displacing uranium as the basis for electricity in the United States. So short of Kazakhstan suddenly be going off limit, I don't see any comeback for uranium. And China is the one with an oil problem, which is why they're really behind the electric vehicle transformation. And a couple of hot metals in the past 5 years have been cobalt and lithium. But lithium is dead. The Australians have stepped up. They're producing a lot. The Chileans and the Argentines are busy expanding what they can get from their salars, their brine deposits. And cobalt, well, thrifting has reduced the reliance on cobalt. It's now a much lower percentage of the lithium-ion battery. But in the long run, the lithium-ion battery is going to be replaced by some solid-state magnesium-ion battery. So neither of these metals, I think, are going to end up going into a sustained uptrend. And rare earth mania, it's a possibility, but it has not yet happened. That chart on the left shows you what it was like in 2009 to 2012. But so far, the Chinese are not playing that card. They are still the lowest cost producer. There's all this noise about America helping companies to create rare earth production outside of China. But the reality is the rare earth prices need to be 2 to 3 times higher than they currently are for any projects outside of China to be feasible to develop. So how that gets resolved, I don't know. But rare earths are still a key part of the electric vehicle sector. And another big one has been vanadium, which had the big rally, but now has gone back to not quite where it started, but considerably lower than before. And both vanadium and niobium, they're steel hardening and strengthening alloys. And lightweighting, even though Trump says climate change is BS and we shouldn't do anything about it, the whole world is looking at reducing its energy consumption footprint. Vanadium has plenty of supply from around the world. Niobium basically comes from Canada and Brazil. So I think niobium is a category of metal that I think the juniors could get some mileage out of, though it would be a very small group. And then the thing about oil-based fuel, gasoline and diesel, it's not going away. Like, I personally have no interest in, figuring out where I'm going to plug my car in and get it charged for several hours. I like my 5-minute refill at a gasoline station. I think the future is going to be hydrogen fuel cells. And the beauty is that, like with vanadium as long-term storage for the renewables of solar and wind during the, when it's blowing, you don't need the energy. An alternative is to make hydrogen, to do electrolysis of water. That's a way of storing energy also. If they can figure out how to ship it to these ordinary gas stations, then you would see hydrogen fuel cells. And that's important for platinum, because platinum is critical to those hydrogen fuel cells. And this is a point Robert Friedland frequently makes. Palladium, it's used in the catalytic converters for gasoline engines. Platinum is used in diesel converters, and that's why you've seen the reversal of traditional price relationship. And another problem for palladium is that Norilsk is undergoing an expansion, which is reducing temporarily, for 4 or 5 years, its palladium output. So we're in a bit of a palladium-platinum bull cycle, and South Africa and Russia are basically the world's primary platinum-palladium producers. So I think these elevated prices that we have are not going to go away. They're not going to go to the moon. But it is time to look at juniors with platinum palladium as a target. And copper, well, copper sort of follows the macroeconomy. Nickel is the big surprise. And so nickel is the beneficiary of thrifting cobalt out of these lithium-ion batteries. But nickel also has this issue where Indonesia in 2014 stopped shipping the laterite ore to China to make nickel pig iron and forced the Chinese companies to build processing capacity. And then they gave them a reprieve until 2020, 2022. But now they're saying the reprieve ends in 2020. So there's a looming nickel shortage, plus demand rising from the electric vehicle battery demand, which is creating for us a bit of a nickel market. And if nickel can sustain $8 to $10, then it's time to look at nickel companies again. And just finally, last year I had Scandium International here, and the stock was doing well, and then all of a sudden it stalled, and then face planted in the new year, and they solved the problem with the mining lease being temporarily canceled. But this is the one metal that's different from everything else, because it's all about creating the offtake market. So if you want this hedge of something that isn't tied to the global economy or to metal price trends, this is now a bottom fish. It's no idea when they'll get that offtake done so that they can build it. So that's what's hurting the stock now. But Scandium has a lot of detractors, like those characters there at the show in November. Not helpful. But if you want to be a contrarian, this is one to look at. Thank you.